What is capital structure? The ratio of debt to equity is known as the capital structure. Ratio of debt to equity. How much a firm should finance against the actual capital it has invested in. That is the equity. Debt by equity. Most cases, this equity will not be sufficient. A person starting a company, he is investing something into the company, and that is the equity. But that might not be sufficient for the firm to run. He may need some external financing, and in that financing is known as the debt, and the ratio of this debt to equity is known as the capital structure. Now let us see what are the assumptions of the capital structure. Yes, the first assumption is the firm is not paying any income tax, the firm is not paying any corporate tax or any other sort of taxes. That is the first assumption. This is a hypothetical situation, as all of you know. A firm's shareholders do have income taxes, and a firm has got corporate taxes. So this is a hypothetical situation. All earnings are distributed as dividends. That is, all earnings are distributed as dividends. Okay. Now next one. Otherwise, we can restate this as 100% dividend payout ratio. Now the subjective probability distributions of operative income. That is, the operative income can be distributed in different probabilities, different chances of distribution. Then operating income will grow or decline. There is a chance for operating income to go up, operating income to go down. And also, if a firm wants to change to a different ratio of debt to equity, there are no additional transaction costs. So this is the base. These are the basic assumptions of capital structure under the net income method. And let us see the cost of debt as well as the cost of equity and the cost of the total assets or the firm, or the cost of the firm. So the cost of the debt is interest divided by debt. Cost of the equity is equity earnings divided by market value of equity. That is, in other words, for the ratio of the earnings per share to the market price per share. In that way also we can restate this. So how much equity earnings do we have divided by the market value of the equity. Now the cost of the firm is such that operating income by market value of the firm. So actually it is a return. How much return a firm is getting, how much income a firm is getting. Earnings, how much return a firm is getting on the equity of the, it is not the book value of the equity but the market value of the equity. That is, if a firm is listing its shares in the market and there is some share price for the market, for the share in the market, and according to the demand of the particular share in the market, that value of one share multiplied by the total number of shares, that is the market value of the equity. Okay, so it is in one way the return of equity. We could say how much one share is earning, or otherwise how much the equity investment is earning. That way we can tell. And this cost of the debt is otherwise there is a market value of the debt. There is a value for the debt, and this debt value is having how much cost. Is it dearer or cheaper? That is, there is a market value for the debt, and for this debt we have to pay this much interest. Okay, if the interest is too high, then the cost of debt is also very very high. If the interest is low, then the cost of debt is low. So on the basis of this, we will decide whether we have to go for debt financing or equity financing or etc. And that will define the cost of the firm, that is return of the firm, RA, that is operating income market value of the firm. And this is defined by this formula. RA is once again restated by this formula, that is total value, the cost of the assets or the cost of the firm is the cost of the debt. It's not the cost of the debt plus the cost of the equity. It is the ratio of the cost of the debt to total debt to debt plus equity. How much debt a firm is financing to the total um, investment, we could say. How much the ratio of the debt to the total investment multiplied by the cost of the debt plus how much there is in equity investment divided by the cost of the debt to the equity multiplied by the cost of the equity. So it is not the actually the simple addition of the cost of the equity or the cost of the debt. I think all of you have got this. So that will decide the cost of the firm.